Welcome to the Coin Bureau Weekly News Roundup. My name is Guy.
And my name is Jessica. Here are the top stories in crypto this week.
Crypto market slump. Coins and tokens trade almost perfectly sideways as uncertainty grips the industry. Where could prices be headed next?
Ethereum concerns rise. Creator Vitalik Buterin sends $1 million worth of ETH to Coinbase, while Bitstamp stops staking services in the US. And DeFi comes under scrutiny. What does this mean for ETH?
Friend.Tech FOMO. The crypto community flocks to the social media dApp as concerns simmer about its regulatory implications and data security. Why this crypto project is more significant than you think.
Online censorship engaged. The EU's Digital Services Act goes into force, mandating all European countries to create their own ministries of truth to track misinformation. Everything you need to know.
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment.
Last week, the crypto market stayed static. If you take a look at BTC's price from a bird's eye view using CoinMarketCap, it resembles a heartbeat monitor. The beat to the upside seems to have been driven by Nvidia's Q2 earnings, which were released on Wednesday night. For context, all eyes have been on Nvidia because of the AI narrative, which has been driving the stock market rally. Nvidia makes almost all the AI chips, so its earnings give us a sense of whether the AI hype is real or not. Well, its Q2 earnings suggest the hype is still real. They came in above expectations. The catch is that stocks and crypto both crashed after Nvidia's earnings were announced. This suggests that it was a sell the news event, but it could have been due to uncertainty around the Jackson Hole symposium on Friday. For reference, Jackson Hole is basically a central banker summit held in the United States. We'll be doing a video about Jackson Hole later this week, so all I'll say for now is that the Fed and the European Central Bank gave mixed signals, and the markets seem to have responded accordingly. Stocks and crypto traded sideways with minimal volatility, though stocks do seem to have enjoyed a bit more of a boost. In any case, it's not just macro factors that have been weighing on the crypto market. There's no shortage of crypto-specific factors coming down the pipe, including Grayscale's ongoing lawsuit against the SEC, BlackRock's spot Bitcoin ETF application, and Sam Bankman-Fried's first court date. The biggest crypto factor that spooked the markets last week, though, was the US Treasury's proposed tax regulations for so-called crypto brokers, which includes DeFi protocols. In retrospect, this is not surprising given that the Treasury had previously refused to clarify what this term meant. We'll be covering that later this week too, so if you aren't subscribed yet, you know what to do. Now, regarding where crypto prices could be headed next, the total crypto market cap suggests we are at a critical level for almost every coin and token. As you can hopefully see, a massive head and shoulders pattern seems to have been painted since the start of the year. Now, for those unfamiliar, head and shoulders patterns are bearish, and we saw a similar pattern form around the most recent cycle top. If this bear market head and shoulders breaks to the downside, most coins and tokens could revisit last November's lows, or worse. Conversely though, if crypto can hold its ground and mount a recovery rally in the next 1 to 2 weeks, the head and shoulders should be invalidated. Now, one way to keep track of this is to watch BTC's weekly price action. It appears that 29k is a critical level BTC needs to get back above to ensure everything doesn't go lower. If you're feeling brave enough to trade what's coming, be sure to check out the Coin Bureau deals page down in the description. It's got up to $40,000 of bonuses and airdrops available for you on the best crypto exchanges, along with the biggest discounts on trading fees you can find. Now, another way to keep track of the status of the crypto market is the ETH BTC chart, which you'll know we've been analysing a lot lately. That's simply because ETH BTC is a proxy for how altcoins are looking relative to BTC. As you can see, ETH is likewise at a critical point against BTC and looks weak. This weakness makes sense given that insiders appear to have been selling ETH in recent months. Some of you may recall that the Ethereum Foundation had sent $30 million of ETH to Kraken back in May. Ethereum co-founder Jeffrey Wilker did the same with $40 million of ETH in June. And just last week, Ethereum creator Vitalik Buterin transferred $1 million of ETH to Coinbase, which isn't much relative to his total holdings, but still doesn't make for great optics. To clarify, when someone sends crypto to an exchange, it's assumed that it's being sold. Whether all this ETH was actually sold is unknown. Even so, there seems to be a correlation between sales by Ethereum insiders, most notably the Ethereum Foundation, and ETH's price. The Foundation's sales have historically happened around local tops for ETH, and some of these sales were reportedly encouraged by Vitalik in 2018. Of course, their track record isn't perfect. Regardless, it all begs the question of why Ethereum insiders seem to be selling ETH. One possible answer is because of regulatory uncertainty. If you watched our video about the SEC's lawsuit against Binance, you'll know that it seems to consider any proof-of-stake crypto to be a security. And if you watched our video about the SEC's lawsuit against Coinbase, you'll know that it considers the staking services that Coinbase offered to be securities as well. Coinbase subsequently stopped offering staking services in 4 US states, underscoring the fact that the regulatory scrutiny of proof-of-stake is very real. This regulatory scrutiny was further underscored last week when Bitstamp announced that it would stop offering ETH staking to US customers. Bitstamp specifically cited regulatory uncertainty as the reason. Now, it's possible, if not likely, that we will see similar headlines about staking services in the coming weeks. And yet, despite this barrage of bad news around staking, ETH staking continues to increase, which is certainly good news. As reported by Decrypt, however, the total value locked in Ethereum's DeFi protocols continues to decline, despite the increase in ETH staking, including liquid staking. Now, this decline in TVL can be partially explained by the fact that ETH's price has come down, and ETH is one of the biggest sources of collateral and loans in DeFi. It can also be partially explained by the aforementioned definition of crypto broker by the US Treasury, which is casting a long shadow over DeFi. There have also been a few scary headlines about the DeFi protocols themselves. One example is a vulnerability in the balancer DEX discovered by the team. They instructed liquidity providers to withdraw ASAP. MakerDAO's stablecoin protocol also seems to have experienced a TVL decline of more than 10%. For what it's worth, though, there is one place that's looking bullish in Ethereum's ecosystem, and that's Coinbase's recently launched Layer 2 Base. If you watched our Base tutorial, you'll know that it could contain some promising crypto projects in the same way that Binance's BNB did when it launched. One crypto project on Base that has had everyone talking is a decentralized social media platform called Friend.Tech. As you might have heard, there has been no shortage of concerns around Friend.Tech. It's also technically not decentralized because Base only has a single sequencer node run by Coinbase. So, to bring you up to speed, Friend.Tech is essentially a mobile app that allows Twitter, or rather X, influencers to create tokenized shares of themselves. These shares can be bought and sold by fans of said influencers, and holders of these shares get access to an exclusive chat with whatever influencer they've bought shares in. In other words, it's OnlyFans for crypto bros. Even the logo looks similar. Well, we get the use cases we deserve, I suppose. In all seriousness, most of the concerns around Friend.Tech have their roots in the project's privacy policy, or rather, the lack thereof. At the time of shooting, clicking on the privacy policy link on its website results in a pop-up which says, quote, "coming soon." To be fair, Friend.Tech is still technically in beta. Still, this is concerning because making a Friend.Tech account requires you to connect your phone number and Twitter, or rather X account, to the mobile app, which isn't even listed on any app stores. In addition, you must fund your account with 0.01 ETH and store your ETH on the app itself. Despite these concerns, Friend.Tech has reportedly racked up over 170,000 users in just a couple of weeks, making it one of the fastest growing dApps in crypto. This is because of the impressive profits that can be made from trading shares of influencers, who now include more than just crypto bros. Friend.Tech's adoption is also due to influencers earning a cut of the trading fees from their tokenized shares. Said influencers also earn points for using the app and inviting their followers to use it. It's believed, not confirmed, that these points will correspond to a Friend.Tech token that will eventually be airdropped. Now, before you ask, no, we do not have a Friend.Tech profile. This is primarily because of the potential regulatory risks which everyone seems to be forgetting about. Issuing shares of yourself that give you de facto dividends sounds way too similar to an unregistered security, in our non-legal opinion, that is. Never mind the fact that encouraging your followers to ape into these shares comes with big risks too, including the risk that Friend.Tech itself is a scam or a rug pull. So far, though, it seems to be legit. And this is why Friend.Tech is so significant. It's too soon to say, but it could be the first of many crypto projects that officially begins the age of decentralized social media, or DeSo. It's believed that a DeSo project will be the one that results in mass adoption. Friend.Tech may not be it, but it could be a start. That said, it looks like the adoption of DeSo won't happen because of the expectation of profit, but out of necessity. If you watched our video about online censorship, you'll know that we believe the adoption of DeSo will occur because centralized social media will get censored to the point that it's unusable. You'll also know that governments around the world have been rolling out their respective online censorship laws, and that some of these would come into force starting this year. One of them was the Digital Services Act, or DSA, in the European Union, which went into force last Friday, the 25th of August, a sad day in the history of free expression. As we mentioned in the introduction, the DSA mandates every EU country to create a Ministry of Truth to fight so-called misinformation, disinformation, and all the other buzzwords used as an excuse for censorship. The official names for these Ministries of Truth are, quote, Digital Services Coordinators. Each Digital Services Coordinator will designate trusted flaggers who will monitor and take down content they don't like. And if you're wondering who these trusted flaggers will be, the list includes law enforcement agencies and non-governmental organizations, which are known to be political. Naturally, any social media platform that fails to appease these digital services coordinators and their trusted flaggers will face severe fines and sanctions. This could become a tool for keeping social media platforms in line, since the definitions of things like disinformation are up to the EU and other elites. But that's not all. As we mentioned in our video about online censorship, quote, the bill explicitly states that in the event of a crisis, the European Board for Digital Services will instruct social media platforms to enhance content moderation, change their terms and conditions, work closer with trusted flaggers, and tweak the algorithm to promote trusted information. Moreover, quote, the Digital Services Act specifies that a crisis includes armed conflicts or acts of terrorism, including emerging conflicts or acts of terrorism, natural disasters such as earthquakes and hurricanes, as well as from pandemics and other serious cross-border threats to public health. Now, the most terrifying part of all is that there doesn't seem to be a time limit on how long the EU and its digital services coordinators could have a stranglehold on the algorithm in the event of a crisis. It seems that they could grant themselves this power indefinitely, and it's clear it's something they'd love to do. After all, trust in institutions such as governments and central banks is in decline around the world. The only way they can keep control is to take charge of the narrative, but the more they try and do this, the more obvious it becomes to the average person. As a result, public trust will decline even further. Now, when people realise that almost everything they see online is being curated by their government and is inconsistent with what they're seeing with their own eyes, they will look to alternative platforms that let them discuss the truth. With a bit of luck, decentralised social media protocols will be these alternatives. And now, here's Jessica with the cryptos that crushed it last week.
Thanks, Guy. Last week's top performing cryptos were Shiba Swap, DYDX, Toncoin, Ape NFT, and Quant Network. Starting with Shiba Swap, its Bone token likely pumped in response to the news that the Shiba Inu team is planning on making its new Shibarium Layer 2 open to the public soon. This relates to Shiba Swap because Bone is used to pay for transaction fees on Shibarium. Bone has had a volatile month, which makes sense considering that Shibarium launched earlier this month and experienced some block production issues shortly afterwards. Thankfully, these issues were resolved, but Bone is still looking weak, having set a lower low in its recent rally. Let's hope that the public launch gives it a boost. Next up, we have DYDX, whose DYDX token appears to have pumped in response to the anticipation of the launch of the DEX's own Cosmos-based blockchain. For those unfamiliar, DYDX is currently a Layer 2 on Ethereum. According to Nansen, the smart money has recently been accumulating DYDX, likely for the same reason. Now, what's interesting is that DYDX's price action provides a mixed picture depending on the time frame. Its daily chart suggests it could see a bounce off the Bollinger Band moving average, whereas the weekly chart suggests it's about to get rejected by the Bollinger Band. We'll find out which reigns supreme soon enough. When it comes to Toncoin, Ton appears to have pumped in response to the release of Toncoin's Ethereum bridge. This will make it possible for two of crypto's largest ecosystems to interoperate. Keep in mind that Toncoin is used by Telegram, a messaging app with over 700 million monthly active users. Ton itself appears to have been in an uptrend since the start of the month, but it's too soon to say if this uptrend will hold against the longer-term downtrend. Ton's relative lack of exchange support also makes it hard to say whether this price action is entirely genuine, though there are no obvious signs of market manipulation. As for Ape NFT, its NFT token pumped for unknown reasons. The crypto project appears to be part of Tron's ecosystem. It lacks exchange support and has been in a very long-term downtrend. Its abnormally low price tag also suggests that it's a meme coin, so I think you get the picture here. Now last but certainly not least, we have Quant Network, whose QNT token appears to have pumped in response to the project's ongoing work on central bank digital currencies, or CBDCs, and the news that it secured a new crypto patent. QNT's weekly price action suggests that it's at a critical point. The Bollinger Band squeeze suggests QNT could see an imminent move to the upside or the downside. The fact that it's below the weekly Bollinger Band moving average suggests that the downside risk is greater, but we've seen reversals from here before. And if you want to know which cryptos are pumping the most and why on a daily basis, be sure to join the Coin Bureau Telegram channel. The link will be down in the description.
And that is all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel.
You can find the link to that resource and many others in the description below.
Thank you so much for watching, and we'll see you all in next week's episode.